It was an amazing 2 days. And you know what I'm most excited for is the fact that it doesn't end there. We get to go on to next week. And we've got great guests next week and experts the following and the following and the following. So as this unfolds, we will learn so much and we'll come together so well as a community. So really happy about that. And away we go onto your LFD Digest. Our first highlight we're going to bring to you is from Scott Penberthy of Google AI, and he is going to talk to us about all the things that have gone on in the world of machine learning and deep learning since he last spoke to us in San Francisco in 2018 on the keynote stage. Now, what is Google's mission here? Simply put, to make AI as simple as search and as powerful as a team of analysts. Let's hear what Scott has to say about that.
We call that democratizing AI. So the point is, could you literally take the documents in to a computer, take your images in, and then start asking it questions in English or in French and have it respond to you, kind of like when you search for Mozart on Google, you'll see an answer come back and the description of who Mozart is. That's actually built by computers, not by humans. So wouldn't it be great for business? So I'd like to be able to talk in and ingest it and ask questions in my inbox. Hey, what should I focus on? Or you get these PDFs came in and said, which one should I read? I've got 2 hours to read. Can you give me a hint? And then later I give it feedback going, these 8 were cool. These 2 were garbage. So help me next time get better.
So now let's hear what Scott has to say about the practical applications of AI, ML, deep learning.
They have a question against a lot of unstructured data, pile of text, pile of regulations. New tax regulations just got released. New chemical regulations. You've got a lot of customer feedback. You've got your call center, same problem. So can you stand this up and say, I want something to dig into that to help me understand where I should spend my time?
And one of the most potent examples of AI in action in a company is through customer service and improving customer service, causing perhaps a reaction among your customers to say something like, I love this company. They get me.
So where's this helping? If you can save cost by 10%, that's interesting. In some cases, it's really interesting. What we're finding, though, is that we've got a lot of reading, got a lot of prioritization. Half is cool. And a lot of it is about the customer experience. Because imagine here's an example. You got all this data coming in if you're a grocery, and you're saying, which question do I answer? And so what do you mean? Well, one question is about, where's my milk? Another question is, I saw your truck. Can I sign up for your service? And you have one call center rep. Which one does she answer? If you want to drive customer sat higher, you answer the milk question, because that's try to revenue. You delight a customer, word spreads faster versus an inquiry because it's time sensitive. We did that for a customer called Ocado in London. Same technology just walked you through. And so what that does is the next thing is that it's, instead of being some exotic thing off the right, it's all about customer experience. So in your business, how can you make it so that you can be responsive to your customer, read the text they sent them or an image they sent you, understand it, and make it so that, wow, you get me.
Next, we're going to quickly review one of our most popular segments, which was small business lending after the PPP. Now here's Brock Blake of Lendio, who sets the stage by describing what happened in the first phase of the PPP, which ironically the government completely left the fintechs out of until it was essentially too late. Now here's Brock interacting with Luke from Intuit.
QuickBooks and PayPal, I believe, were the first 2, but their approval came so late in the process. I don't know, Luke, were you guys able to get any deals done in the first round? I know you guys were approved so late.
Yeah, it was small, right? Like we were approved on April 10th. We took applications starting on April 14th, and then the money was gone pretty quickly thereafter. Yeah. But we did get some SBA loan numbers and funded some customers in the first round, but it was pretty small.
Now on to round 2 of the PPP. Brock explains how it was completely different, and they did, along with many other fintechs, engage in distributing capital through to the smallest companies that arguably need it most.
So round 2 for us has been a much different scenario in that we have a lot of distribution. There's good diversification. Lenders have now they've gone through the process of underwriting the loan and payroll verification and all of those things. So round 2 is just completely different than round 1 because of what we've learned.
Right, just real quick before we move on, Brock, how many lenders have you sent loan applications, or what's that sent borrowers to for the PPP?
Yeah, it's about 330 lenders.
Wow. Okay.
Fintechs like Bluevine are now helping those companies that have been waiting for weeks for the PPP. Here's Eyal Lifshitz.
Even when you look at the statistics of the banks, their average is still 80,000, 100,000. They're not doing like the $10,000 loans. And increasingly in the program, what we're seeing is that this is the demand that's left. The ones that are looking for $1 million loans, those got served in the beginning. It's the sole proprietors, it's the smaller businesses that are looking for $10,000, for $20,000. That's the ones that are still looking for a loan. Those are the ones that have been sitting in the queues of the large banks for 3 weeks now. And we're doing our best to address them and serve as many of them as we can.
Similarly, QuickBooks, which has 6 million small business customers, has been extremely responsive. And here is Luke Walls commenting on that.
If you look at our payroll population, there's 1.4 million businesses that use us for payroll. The average, 80% of those businesses have less than 10 employees. 57% of those businesses have less than 5 employees. So we serve kind of the smallest of the small. Our initial average size is around 40,000. It's down to close to 30,000 now. If you look at the self-employed population, the average size is between 6,000 and 7,000 on a go-forward basis. So yeah, we are seeing that average come down, and it's interesting. You see it trending over time, smaller and smaller, because the larger businesses get served elsewhere, but we're still open and serving these small businesses.
Impressive numbers, and check out the speed with which they can create a PPP application for their payroll customers.
I think the median time to complete the application through us is 5 minutes because we have all the data and you don't have to upload documentation if you happen to be a QuickBooks customer or a QuickBooks self-employed customer. It's a fully automated application and you get through relatively quickly. So it's a pretty great experience if you are a customer.
Now we're taking audience questions the whole time during these panels. And one of our members posed this question, which I know by the asker of the question, he didn't really believe this. He was playing devil's advocate, but he said basically, why don't we just let the small businesses fail? And let's invest our money in the more stable businesses, the mid-size and the large companies, to which Mark Ruddock of BFS Capital had this brilliant reply.
The problem with that logic is as follows. If you're looking at overall macroeconomic recovery, the vast majority of jobs in the United States and Canada and elsewhere are in the small businesses. So if you kill the small businesses, you kill the jobs at a much greater proportion. I think there's also a fundamental fallacy in that thinking, which is that small businesses are not able to respond and to cope. I can tell you that we may very well be seeing a return to small in some respects, as people are looking to go and buy locally and operate within a margin of safety in their community. It may be tremendous upside for small businesses here. I think what's interesting is that the small businesses perhaps are the ones that have the least amount of muscle or fat, if you want, to make it across a time of kind of economic starvation. So they need the help. But on the other side, they're the fastest to respond.
And some good news from small business with respect to forbearance and the kinds of activity that Mark Ruddock is seeing at BFS Capital.
The cash to contractual ratio, which is a ratio of what people are paying versus what if they were paying all of their loans on time or following the modification as per agreed. Mm-hmm. That ratio for people on modifications right now is far higher than it normally is for people traditionally on modifications. So those companies that have worked with us to establish a new forbearance mechanism, they are holding firm to their commitments, and that's very encouraging. That's the first thing we've seen. Modifications are now way down in the last 2 weeks. That's very encouraging. And the third thing is that we are seeing across pretty well all states and across most industry segments, a rebound in the quality of what's happening.
And Luke Walls from QuickBooks makes this excellent point about the resilience of fintechs and what those survivors will find at the other end of this economic challenge.
There are going to be some winners on the fintech side too, the ones that make it through and can prove that they're resilient through a cycle like this one, which is a cycle like no one ever expected. The ones that make it through this are going to be like battle tested and will come out the other side in a proven way that will allow them to really take market share and scale.
Now, switching tacks a little bit, we had another session called The Digital Banking Moment Arrives. And Amanda Swoverland, who is an officer at Sunrise Banks in Minnesota, talks here a little bit about the magic of the human interface plus technology that community banks can capture. Now, she also touches on a very interesting point, which is not just magic, but the activation energy required to get customers, in this case businesses, to switch banks.
We've gone out and met with people, and we ask, who do you bank with? And they'll say one of the big banks. And we'll say, well, what's your experience? And they'll say, we hate it. We're like, well, then why do you still bank there? Because it's easy. I don't want to switch, right? And I think that we see the same thing with businesses. They like to be able to call their banker. They like to be able to have that. So how can we start to build technology that allows us to have that quick ease of use, but just knowing somebody is still there? Like, you might not ever call that person, but knowing somebody who understands banking and how to solve your problems is still there if you need them, is I think, if we can find that magic of how to combine those things, there's something there.
Now, millennials are growing up, and so they're facing different decisions, and they're looking to trusted advisors to help them with those decisions. So, for example, as Di Chao-Bei said in this session, they might be considering trading in their Vespa for a Prius. According to Di Chao-Bei, those institutions that are going to help them make those decisions are going to get an edge up. Listen to Di here.
The fintech or the bank that helps them make those decisions ultimately will play a part in those financial transactions. And I think that's really where the race will be.
Now, Elliot Lim of Mambu has a couple of very salient things to say about the long-term effects, positive effects, in fact, of COVID-19. This first one on purpose and culture.
The culture actually means a lot more than it probably ever has done before. And that's something we all say we think about a lot, and we do a lot, but actually now it means something, and it really, really is valuable.
And according to Amanda Swoverland of Sunrise, community bankers are thinking about banking differently now, post-COVID. And that's a good thing.
How we think about banking and has changed, and I hope other community bankers see that same mindset, because I truly think that's what's going to help move us forward and really save our craft.
Back to Elliot Lim from Mambu, the what if type of analysis is going away, and it's being replaced with...
We're now about what, when. And that is a huge, huge shift. And it's actually very healthy because it makes us do the right things pretty much all the time now, which is good.
Hats off to Will Beeson for moderating that session. That was awesome. You did a great job. Thanks a lot. Speaking of doing the right thing, Sandy Kemper of C2FO makes a serious proposal to the government to step in and effectively underwrite the accounts payable of large corporations to kickstart the flow of capital through the supply chain. Listen to Sandy explain it here.
Of the Fortune 1000 in the United States, on average, they have 3,000 small and mid-sized business suppliers in their supply chain. Well, if there's 1,000 central nodes and they all have 3,000 suppliers who are small and mid-sized, for a facility that would go to the larger, more credit strong central nodes, predicated on that flow going then to the suppliers, mid-sized and small suppliers, you could satisfy millions and millions of small businesses without taking additional credit risk by creating a fund that would go to large companies with a specific idea, specific prerequisite that they must then use those dollars to pay their small and mid-sized suppliers earlier. That would put, in our opinion, a fairly significant amount of capital into the system and in a very de-risked fashion. And happily, as you saw in the note I sent to you last night, now the Federal Reserve and Treasury and the Hill are beginning to back our plan.
Now listen, if you're interested in this proposal, you really should watch the whole thing. It is posted in the replays session of Lend It FinTech Digital for members to access. But here's the zinger that Sandy sent in the middle of this conversation with Jane Atherton of Temasek. And that is, why is this preferable to issuing more credit directly to the SMEs?
And frankly, as a small business or a mid-sized business, wouldn't you prefer to be paid early as opposed to having to borrow more money?
Now, what about the consumers? How are they faring? We talked to consumer debt expert Perry Rabar of DV01 to walk us through an analysis of consumer health, and particularly when it comes to installment loans. Now, Perry is walking us through report that they released later this day when we had this discussion on Lend It FinTech Digital, and he's previewing some of their conclusions, which are super interesting. Listen to Perry here.
The metric that we've always looked at is total impairments, which is a combination of modifications and delinquencies, and how does that fare versus unemployment? And we finally got some real unemployment numbers. The top line number was 14 and then change, and then there was some reporting discrepancies that they talked about, which brings the real number to about 19 or so percent. And we're looking at in this space a total impairment of 15.5%, of which 11.5% is modifications. And that total in the top line number is maybe just 10% above norms. So if you think that we're still trending below the unemployment number, that's a pretty good metric for this space. And then the newest thing that we were talking about in this report, which should be going live any minute now, is just that we're starting to see that total impairment number come down.
So if the consumer installment loan metrics are solid, what does that mean for the market, both now and in the future? Here's Perry again.
I think the market's been fairly orderly. And I think what's, again, I try not to sound too bullish on things because it's not a bullish sentiment. Like I think there's a lot of pain in the consumer and for sure. But I think for me, it's important to anchor that in the proper context, which is, for many years, this market had a rap as if these loans were just going to default. And, now it's not. If you look at kind of how the delinquencies and the mods are trending, it's in line kind of with some of the stuff that you're seeing in the mortgage world. So in terms of payment hierarchy, I think it's important that even if this is stimulus driven, people are still spending stimulus money on paying this loan. And right. So then you could look at this purely from more of an economic perspective of what's the health of the consumer. And that's way easier to analyze as opposed to some sort of psychological, is the consumer going to pay this loan or not?
Now, David from Atalaya Capital explains sort of a polar optimism that they're feeling inside their shop.
I think we're optimistic really long term, and we're optimistic in the very near term because of stimulus, and I think it's that intermediate term that we're really focused on. And so I think if you align yourselves with the right origination partners or the right borrowers, I think you're going to be great long term. And I think this definitely is going to shake out some folks in the industry. And the real key is, who are you partnering with and how tight is their underwriting? And I think long term, those are going to be folks that are really well positioned to grow out of this.
Following that, David explains where Atalaya Capital is still investing.
We're actually continuing to deploy capital in this market environment, but we're trying to focus on short duration assets for the most part, and also trying to focus in areas where you're higher in the payment hierarchy for consumers. So the other, where sort of whole loans are on the table, lending to platforms are on the table, and also now securities, right? There's really three ways to gain exposure to the asset class. It's lending against the asset, purchasing the asset, or buying the securities. And so for us, that last bucket has become obviously a lot more operative over the past couple months. We've been, very aggressively looking for opportunities there, been buying some, and as this market rally has continued, have sort of slowed down our pace there.
That said, for any platform investor that is going to develop a relationship potentially with a new platform in this market, definitely a stretch. Let's listen to what Nicole Burns of the Canada Pension Plan has to say about that.
I think the hardest thing to do with new relationships right now is you can't meet people face to face. And I think, in that respect, I'm a little bit old school that, being in the same room with somebody for a few hours talking about their operations and platform really is a good, a telltale sign of do you want to invest with this company or not? When you can't do that and you're kind of stuck on a conference call and you have to sort of get that sense, it's hard.
Now, despite the optimism that we heard throughout this consumer credit panel, Nicole Burns of the Canada Pension Plan did bring us down to earth a little bit when she explained, look, there's a lot of noise in the system, so getting a good read is tough, and it's not entirely clear how this is all going to play out.
There's so much activity going on with those modifications and so much noise around the stimulus checks going out that it's really hard to see what the true effect is on unsecured consumer.
Now, related to that, but in a different session, we had Mike Cagney offering up a broad analysis of the stimulus and the kind of weirdness that it's creating across markets. Here's Mike, interviewed by Greg Schoenberg.
What's interesting right now, and I think some of the big ramifications about the actions in the market right now, if you look at things like payment forbearance, it provides consumer relief, but you run the risk of creating a zombie housing market. You look at TALF, it's pretty odd what things are selected in TALF and what things aren't. So for example, commercial real estate's in there, but resi real estate's not. And so you have this weird dislocated market where certain segments are being uplifted, corporate bond issuance, investment corporate bond issuance, even fallen angel issuance, which, I think historically would have been unheard of for the Fed to go into. You have, the AAA securities on the TALF side, and then you have big swaths like prime jumbo, which is traditionally a great performing asset class that right now doesn't have much of a bid because there isn't any institutional or isn't any federal support for it. So I think we're in a weird situation where, between the Treasury and the Fed, they've kind of, whether explicitly or implicitly, picked the haves and have-nots of the first phase of this. But the reality is, even if they're willing to back AAA securities, if credit deteriorates and you can't generate a AAA security, then there is no liquidity takeout.
And now we have a special treat for you. In the words of my colleague Todd Anderson, Mike went full Cagney on us. Now, we're going to play it back for you at 2x speed. And I know it's dangerous. Your mind may melt, but we're going to do it. So buckle up. Here it comes.
By the looks of it, you got it done at a very attractive price. Can you just kind of give the contours of that deal?
Yeah, so it was a little less than $200 million of collateral. It was collateral that we'd sold to one of the hedge funds. So they had kicked the collateral back into the transaction. They retained the residual off of it. The senior bond, it was an 85 attached. Senior bond traded off at 4. The cover on it was actually 3.5. So the cover was through the takeout for the senior. And the reason we didn't take that is we wanted to build momentum into flock 2 to drive down the senior bond price or senior bond yield and drive up the price in the first transaction.
All right, so that was fun. In all seriousness, Mike goes into that great detail because he's trying to point out the value of provenance, the blockchain that Figure was able to capitalize on and to offer beneficial terms to the investors. So taking a lot of the cost out of that securitization. Here he explains it in some detail. And we'll go back to 1x speed for this.
But what was most important for us were a couple of things, which is the cost to originate those assets were about 55 to 60 basis points cheaper than they would have been had we not used blockchain. So, leveraging blockchain as a custodial platform versus a vaulting service, as a servicing platform versus paying servicing onboard fees.
It really was a brilliant interview by Greg Schoenberg and Mike Cagney. I mean, these are two very bright people, and listening to them converse about Figure and provenance and the future of finance was fantastic. Now, the only thing that could have outshined it, and in fact did, was overtime. For those of you that are unfamiliar with overtime, it is where after every major session we do, we invite everyone to this separate meeting, which is password protected, and everyone that was in the first meeting can come to the second. And so this is where we break down the walls. Everyone gets video, everyone gets audio. It's a big mosh pit of Q&A. And so a lot of people got to ask Mike direct questions, and he answered them very frankly, and it was awesome. And it left us with just one question, which is, what area of finance is Mike Cagney not going to change? And that, my friends, is still open for debate. All right, so let's give the last word to Perry from DV01 with the new definition of optimistic.
I just haven't been horrified. I think in this circumstance, I think that's optimistic.
That's a wrap, folks. That is it for Lend It FinTech Digital and your digest for this week. We just covered May 13th and 14th. It was a 2-day blitz of material, and we're just super happy with how it went off. The enthusiasm of the audience, the participation of the membership, it was great. So thanks for bringing your best energy, and thanks to all those keynote speakers, the moderators, the interviewers, everyone that came to play, all the panelists. That was a fire hose, and it was wonderful to be a part of. My favorite was overtime, and I hope you got to enjoy it because it was truly a fantastic experience. Now, again, we got a great reception, we got great feedback. Keep the criticisms coming. We want to hear those. We want to know how we can improve, and improve we will. And the stuff that's working, we're going to keep working. Until next time, Keep up the hard work and take care.